Real estate is unlike most other consumer purchases, durable goods, automobiles, whatever. It lasts forever. So once you build a house or build a building, it's going to last hundreds of years. There's buildings in Europe, if anybody's gone, they've been around thousands of years and more.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Levredge and Jeffrey Holst pour out old-fashioned real estate advice.
Episode 38.
Welcome back to the Old Fashioned Real Estate Show. My name's Jeff Holst. This is
Brian Levredge.
And we have an amazing guest today. Our guest today has been called the Contrarian's Contrarian. He's been at the forefront of predicting real estate and actually all market cycles since the late 1980s, when he was predicting that Japan's economy was going to stagnate in the 90s. This is at a time when people were predicting that Japan's economy would overtake the US's. On a personal note, I met Harry Dent last summer at a conference where he predicted that we were going to be facing a market correction and a real estate crash. He talked about a giant bubble that we were in. And then a few weeks later, I met with him at a bar in Puerto Rico. At that time, he told me something that is actually stuck with me to this day. And he said, we're in a giant bubble. I don't know what is going to cause it, but something's going to burst this bubble. And then he said something that he might not even remember saying. I don't know if you remember this, Harry, but what you told me was it could be anything. It could be an oil price correction or even a global pandemic. Those are the exact words you said to me. And I said, because I'm very prescient, I don't think that's going to happen. But apparently I was wrong and you were right. So thank you for coming on the Old Fashioned Real Estate Show and sharing some of your wisdom with us today.
Sure, nice to be here, Jeffrey.
Yeah, it's really great to see you again. Like I said, we met up last summer in Puerto Rico, or I think it might have been early fall. You're still living in San Juan?
I am. I moved there 4 years ago, not for the tax advantages, which a lot of gringos do. I had a vacation place, a property I bought on an island with an unbelievable view 25 years ago, and I just had to come here to finish the darn thing.
Well, yeah, but you don't live in that. Like if I understand correctly, that's on an island off the coast of the main island, and you live in San Juan. I
live in San Juan, where there's real restaurants and entertainment. It's the only first world city in the Caribbean. So yes, and I love San Juan. And I hate to say it, 20, 30 years ago, I wouldn't have moved here, but now, oh, great.
Right. Well, and I think my wife and I came to San Juan, and that's when I met up with you, and you made some suggestions of some restaurants and stuff, and I thought it was fantastic. I suspect right now with the coronavirus going on, maybe the restaurants and stuff aren't quite as fantastic as they were last summer.
Well, they don't exist. You can only get a little takeout. Yeah.
Yeah. So is it still pretty locked down in San Juan?
It is. They're just opening up in the last week. I finally got a haircut, lucky for you guys, after 3 months, just literally yesterday. So, yeah, now it's slowly opening up. But, Puerto Rico got hit by the hurricane, much like this virus, shut it down, electricity, almost everything for 3 months, and then came back slowly. So anybody that thinks that we're going to come back from this virus once it's over, first of all, it may come back. But second of all, even if it is largely over, you do not come right back to normal. It's not possible.
Right. Well, so a lot of people are saying we're in the middle of a V-shaped recovery, and I know you don't think that's the case. You think we're
not possible. I mean, we're already in an economy overstretched by 11 years of printing money, super low interest rates, saving banks, saving businesses, saving the economy, such that it's so stretched now that all it takes is this crisis just for a few months to throw us into high unemployment, even with government stimulus. And I'm just telling you, a lot of, especially small businesses, won't come back out of this. And I'm telling you, within a block and a half of me, 20% of the restaurants, maybe more than that, never came back after the hurricane in Puerto Rico in late 2017. So that's the sort of thing. You come back, but it's going to be slower than people think. And I say there's such a bigger debt crisis and demographic slowdown that's been happening since 2008, which I predicted 20 years before that. That the economy is going to be shown to be as weak as it is. How come it has taken $20 trillion of global central bank money printing and a 6% a year deficit, fiscal stimulus poured into the economy in the U.S. to just get 2% growth. That is saying our economy is way weaker than most people think. If we had not had all that stimulus, we would have seen the 2008 recession turn into a depression.
So do you think we're going to avoid a depression this time, or are we stuck with a depression for sure this time around?
I think we're stuck with a depression. Now, there's two scenarios. One is that we do the same thing as Japan for 30 years now. Just print money, never let the banks fail, never let debts be written down, which is actually a really good thing. Imagine you're a business or a consumer household with debts that are not productive now, that you bought a house that was worth more than it is, or you bought a factory you don't need, and you still have to pay that debt. Wouldn't it be better to have that debt be restructured like in a Chapter 11? So that's what should have happened in 2008, 9, 10. That's what happened in the Great Depression in the early 30s. And you know what? We came zooming out of the Great Depression in the 30s. We came limping out of this, and we're going to go right back in until we do what we needed to do. You got to restructure debt. You got to let zombie banks and zombie companies fail. And like this virus, which is the good part of it, it's a jolt to get us to say, oh, wait a minute. Why do we go to work every day? Oh, wait a minute. Why do we travel for this? And all this stuff. And next thing you know, we're going to figure out better ways to live and do business, and it's going to come out better. I was supposed to be just coming back from a May tour, 2-week tour in Australia. Well, I didn't go, obviously, because of this. And in the meantime, I did a bunch of webinars and a full day live stream, which these guys over there said could never be done and attract people. And they made more money than in the live tour. So I won't have to travel to Australia as much to make money because it kills me with jet lag.
Yeah, no, that trip to Australia is no joke. And I guess it probably has a little bit of a tax advantage for you to be working from Puerto Rico anyway.
Oh,
So
there is. I didn't move here for it, but when I got here, some friends on my newsletter got me into, just slotted me into a company. And now I also save taxes in addition to living costs and being closer to my vacation home, which I would have never finished if I had to move down here to be closer to it, you know? So
right. So since you brought up the newsletter, I want to point out harrydent.com. That's the best place to sign up for that. And it's a completely free newsletter, right?
Yeah, we have paid newsletters. We have a free newsletter. It's daily from me and my partner. Get to know us. We have a very different way of looking at the economy, as you know, Jeffrey. I mean, economists hate me because I do not use traditional economic methods. I look at what people do predictably, from adopting new technologies on an S curve to spending more money as they grow up and advance in their careers and raise children. And so that's how I can see things different. So we just say, look, get on our free newsletter, get to know us, and eventually you want to be on our paid newsletter, but no rush.
Yeah, well, listen, I've had the free newsletter for a while, actually. I think since we first met, and I read it almost every day. It's very involved, and it's great stuff. I mean, and it's not always it seems like, you know, you're trying to portray the complete picture, right? You're not talking about this is for sure what's going to happen, but these are an array of things to be thinking about and how you should be processing them. And I really like that about the newsletter. So I would encourage our listeners and viewers to get on there. So we're a real estate show, right? And I know you're not all about real estate, but I mean, obviously market cycles, and you're a big cycle person, impacts real estate. And then COVID is probably going to impact real estate. Last week, we had on a futurist who's a technology cycle guy. And he said, Dr. Ian Pearson, he said that we should all just be buying pretty places. So we should buy your beach home in Puerto Rico.
I have the best view in all of Puerto Rico. I mean, literally.
Well, good. I look forward to checking that out one of these days. So maybe next time I get to Puerto Rico, we can make that happen. But so do you think that's where we should be parking our money? We should just buy beach homes in Puerto Rico right now, or somewhere like that?
That is not the best place, because vacation homes are not only discretionary, but they tend to be dominated by upper income households. All the bubbles, the greatest bubbles in real estate, and of course in stocks for the same reason, are by the upper 1% to 20%. That have the highest incomes and control 80-some% of the financial assets in the United States and even around the world. So I don't my property I'm holding for now, because it's going from 25 to 5 acre zoning, which you know what that does in real estate. My God, 5 lots with 360-degree views are worth a lot more than one. But I tell you, otherwise, I'd be selling because vacation properties bubble and they're in the coolest places and the hottest cities. Manhattan, San Francisco, Vancouver, Sydney, Melbourne, where I lecture a lot in Australia. You go around, Austin in Texas. The hottest cities bubble the most because the most money and the best people chase them. But when the bubbles burst, it's that money. It is the upper income and wealth people that lose the most in a bubble. The everyday person may lose their job for several months or even a couple of years, like the Great Depression, but they don't lose all their assets because they didn't have that much in the high-end assets. I'm telling you, remember Ted Turner, if people do, in 2001 or two. He was on TV, on CNN, his own station, almost crying, like, I lost $9 billion, and everybody's like, Ted, you're still a billionaire. It's like,
Terribly, though, right? Because
Buffalo, I can't do all this stuff. He lost 90% of his wealth in 2 years in the last tech crash. So that's what's going to happen to the wealthy people. So I tell people in real estate, the higher in the markets, the higher the valuations, the more you should be worried. If you got a home in Omaha, down the street from Warren Buffett in a place that didn't bubble because nobody wants to live there and there's no growth, don't worry so much. Now, also apartments do better. Rentals even do better in downturns. Medical facilities are in good demographics for the aging baby boomer. They hold up. The two areas that go down the most is high-end real estate, especially McMansions and residential, and commercial real estate. Businesses are not emotional like people. They just cut their leases or sell out or whatever. And commercial real estate goes down the most.
So what you're saying, I think, is that our viewers and listeners should be focusing on. I mean, I guess, and maybe you're not. I don't want to put words in your mouth, but I think you're saying if you own, workforce housing, you're probably okay. If you own $150,000 houses that are starter homes, you're probably okay. But don't buy the 6,000 square foot house on a golf course because that's going to be a problem.
Right.
Don't buy the stuff in Manhattan and those kind of places.
Right, exactly. I always say the greater the bubble, the greater the burst. And Jeffrey, here's a good metric. At best, when this second real estate bubble bursts, and it's more overvalued than the first one because the net demand because of slowing demographics and aging the baby boomers is actually less. But they could go down 50% or so, the average, the typical real estate. What was your house or vacation house or office building, anything, what was it worth at the bottom that happened between like 2009 and 12 in real estate after the last Great Recession? That's the best case. It'll at least fall to there in this scenario. Worst case, where was it at when this whole real estate bubble started? Real estate didn't bubble like stocks until 2000. When the stock market bubble burst, everybody said, well, now where do we speculate? Oh, real estate, it never goes down. They're not making any more of it, and real estate is more solid. Well, that's when that. So look at those two figures. What was your real estate worth at best in, let's say, 2009 or 10 or 11? And at worst, what was it worth at the beginning of 2000? That's your range of how much it could fall. Then you'll know whether you can live with that or not. I'm telling you, most people outside of Omaha and somewhere in the middle of Oklahoma are going to be shocked when they look at what their real estate was worth just 10, 20 years ago.
Well, we might be okay in Chattanooga then, because I haven't seen huge price increases here. Yeah. But listen, a lot of places I know that would be 70, 80% reduction in value to go back to 2000.
Yeah. I tell you, it's typically going to be 40 to 50%. But yes, in high-end real estate in certain areas, yes, it could be 60, 70, even 80%. I'm frankly sitting here in Puerto Rico, going to live here for a while, but when my doctor tells me I need to be down the street from the Miami Heart Institute, where my wife grew up and where we would live if we didn't live here, I would buy, in this next crash, I would buy the condo that goes down, and those will. High-end condos in Miami, like last time, will go down 70, 80%. We watched it. We were there at the time. and we sold out right at the top in late 2005. We will buy that condo in Miami and not buy here in Puerto Rico, even though it's more affordable, but it doesn't have any demographic growth here. So I would buy that to move back in my retirement, and that would be what I would do. So the bigger the bubble, the more risk, but the best places, the coolest places will always tend to come back the most. And so that's where you want to buy real estate when it does crash, if I'm right. And the next buying opportunity in real estate is going to be, I'd say, late 2022 into 2025, later than stocks. Stocks is going to be late 2022 or so. I've had several cycles, Jeffrey, forever, that have pointed to late 2022, like late 1982 and late 42 after the Great Depression is the greatest long-term buying opportunity in real estate and stocks and everything.
So that's a 40-year cycle is what you're talking about.
That's a generational cycle. That's the bottom of each generational cycle. Now I have a 90-year cycle, which is technology driven. Every 45 years, new technology, steamships, railroads, automobiles, jets, just in that sector. I mean, these are almost exactly 45-year peaks. Every other cycle, they come together, like steamships and railroads, and like home appliances and computer appliances and the internet and stuff. And you get a super bubble and a super crash. So on a 90-year cycle, we are due for the biggest crash since 29 to 32 from right here, early 2020, which ended up being, could have been a little earlier, could have been a little later, into the same date, late 2022. So I got 20, 40, and 90-year cycle bottoms, all pointing to late 2022. The difference is real estate takes longer to correct, longer to come back. So people in real estate will have a longer period between late 2022 and I'd say maybe 2025 to pick up bargains galore after this downturn. But you got to remember, real estate, and this is one of my biggest demographic insights I got 7 or 8 years ago. Real estate is unlike most other consumer purchases, durable goods, automobiles, whatever. It lasts forever. So once you build a house or build a building, it's going to last hundreds of years. There's buildings in Europe, if anybody's gone, they've been around thousands of years and more. So when you get an older generation as big as the baby boomers dying, which they are going to be doing into 2039 or so another 2 decades, that offsets the demand, the net demand for young people who want to buy the biggest house at 41 to 42 or their starter home at 31 to 32. So normally the millennials would drive up, real estate prices, but they're going to be fighting dying baby boomers, which has already happened in Japan. Japan's real estate bubble burst in the early 90s along with stocks because their baby boom came much earlier than ours, drove up bubbles in stocks and real estate, just like ours, crashed. But when the millennial generation came there, they're not as big as the US, but still substantial. Real estate didn't even bounce because aging baby boomers dying who are sellers put downward pressure on the prices because upward pressure on supply. Oh, here's empty houses that we don't have to build because people are dying. So this is real estate will never be the same. And I think you called Jeffrey your old-fashioned real estate. Let me give you old-fashioned monopoly. What happened? How did you make money in real estate? Monopoly is all about real estate, whether it be utilities or houses or condos, whatever the hell. How did you make money? On appreciation? The rents. Real estate value is its rental value. And in better areas, it's good. And higher end, it's good. And it goes up more. And in declining areas, it goes down. And I just put out a newsletter just this month saying, look in all the metro areas in the US and saying, okay, first of all, which ones have bubbled up the most? Those will go down the most. I'm sorry, they just will with a few exceptions. But those will be the ones you want to buy. But when you do turn around and buy, you want to buy the real estate, the cities, and in the areas where in this second real estate boom, the real estate went to new highs. On average, real estate only caught up to the last boom or a little less. So those are the ones that are showing higher quality of life people are migrating to. And of course, that's Texas. I mean, off the charts, Texas. In Austin, the best there. It is still, parts of California, not the Valley anymore. Screw Stockton and in Bakersfield and stuff that are commuting from horrible areas far away. Those will not come back as much. But if you look at that, it'll tell you where to buy. But I'm just telling people historically, and Robert Shiller, the only mainstream economist I respect, the only one, because they all study government policies and theories and not what people do like I study. So he says real estate long term, and he's proven it back to the late 1800s, only goes up with replacement cost. What does it cost to build a new home on this damn lot, damn it? Well, not in a bubble when things are scarce and everybody's speculating, but the demographic growth in most developed countries is not going to be great. You're going to have to be in the best cities, and you're going to have to be in the best real estate. And I'll tell you, if I could buy one thing in real estate, I'd buy nursing home and assisted living facilities, things that can be used for that, or companies that have that real estate. Remember, like McDonald's admit, we're not a fast food play. We're a real estate play. We bought up the best real estate around the world where people buy the most crap, and their burgers aren't crap, okay? They're the least rated burgers that sell the most. That's classic, okay? So nursing homes and assisted living facilities are going to be the one thing the baby boomers, still an outsized generation in size and percentage growth compared to the millennials or the zillennials or anything to follow in developed countries. That's going to be the most desirable real estate in the coming decades after this crash. And I spoke for a guy, Gene Guarino, I think his name was, who helps people buy McMansions, large suburban homes in peaceful areas to turn into assisted living facilities for 4, 5, 6 clients. And you can make more, 2 to 3 times what you could rent out that house for by doing that with a little extra effort. Well, that's the McMansions are the most overpriced, as I hinted earlier, will go down the most, and nobody will want them. The aging baby boomers want smaller homes to downsize into retirement, because they don't have the kids anymore. The millennials want a starter home or maybe a bit more. Nobody's going to want McMansions. We'll turn McMansions into assisted living facilities. Oh my God. That's the next billionaire opportunity.
So we look for.
We need to have good services. So I would look for a franchise that could pull those together. But buying that real estate, oh my God.
So probably single level McMansions would be the best then, right? Because the stairs would seem to be problematic for assisted living.
Yes. Quiet areas, and yes, one floor. Old people don't like to walk upstairs, no question.
So you should just buy those old roadside inns and convert them into assisted living individual home type places. Those one floor, 20 doors.
You could buy apartment buildings. The problem, the other cool trend in real estate, which I only realized when I talked for an apartment conference last year, apartments are driven by young couples getting married, into 27, 28. It used to be 26, now it's 27, 28. Okay, well, wait a minute. That's peaking with the millennials. But I just looked at demographic data that showed, wait a minute, baby boomers, as they've aged now and getting close to retirement, sitting in a McMansion, it's worth a lot of money, and that's their only asset. And they say, wait a minute, and they never save for retirement. Baby boomers never saved because they lived in good times, unlike the generation before them, the Bob Hope of World War II. And they're thinking, and rightfully, by accident, for the wrong reasons, they're thinking, wait a minute, the way for me to get my retirement plan up to snuff is to sell this McMansion at a high price, get a big profit because I have very low mortgage against it or none. And that becomes my retirement plan instant, and I rent. my retirement home. What? That's never happened before. Old people would be the least likely to rent until they're damn near done. So the new trend in rental apartment properties or kind of rental areas is aging baby boomers. They want a little higher quality. They want more service. Da 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 da.
And less
So
stairs, right? So that's I think what you said before when we were talking the single family stuff. So that's really interesting. So if you were a real estate investor instead of a market cycle guy, right? Like if that's what you did for a living, you were a real estate investor, would you sell everything now anyway, even though there's some safe harbors, turn it to
yeah.
cash and wait for the crash?
Okay. If I had really good cash flow positive real estate in more central areas of the country that are not as bubbly, I think I would keep that. Here's why. You've got a business that's doing well in a downturn. You got cash flow, so you will be able to borrow, or not so much borrow, but when a lot of company real estate and people and companies go bankrupt, you'd be able to take over other properties like yours in bankruptcy without putting money down, just because you have cash flow to pay off the loans at maybe 50% of the value of the loan. So maybe you take over some real estate you want for your business, apartments or whatever, or rentals to millennial families and stuff. You take it over at 50% of the mortgage with no money down because you have cash flow to support that, and so that cash flow could be worth more than your credit rating.
You know what? That's so you don't know this about me, I don't think, but in a former life I was a bankruptcy attorney. That's what I did before I got into real estate investing. And in 2008 I was doing bankruptcy, which was it was a great time to be a bankruptcy attorney, right? There was a lot of bankruptcies, and I lived in a community that was near a GM plant that shut down, so there was even more bankruptcies, right? Because GM went through their bankruptcy, and there were several businesses like one was a car wash. That was a kind of a self-contained automated car wash thing that the loan on it was about $1 million, and it was in bankruptcy. And one of my clients who had other car washes that he had bought years before was able to pick it up for $300,000, and the bank just gave him the property. This is essentially what you're saying, right? Like if you keep at it, you're going to be the credible person. You're the person that, as long as you have quality, a quality business plan and you're making money, then you're the one that the bank's going to take a chance on.
Right. If you have, Jeffrey, either cash because you sold your real estate or your business or your stocks at the top of the bubble, or if you have a business that is surviving and maybe even doing better. I mean, there's businesses, obviously, pharma, biotech, and online businesses that have done even better in this virus crash. If you're that sort of business, then you can take over your competitors and failing businesses and failing real estate at 10, 20, 30 cents on the dollar, 40, without even putting out more money. So cash, I say cash is always the best. You got a pile of cash, then you just walk into that bankruptcy and buy it for 30 cents a dollar. But if you got cash flow as an ongoing business that is actually doing okay or even better in this downturn, you're going to, again, why wouldn't a bank want to transfer failing assets to you at a big discount to at least get 50% back on their loan or 40% instead of 10% in a fire sale? So yes, either of those strategies works. And so the higher the value my assets, if I have really high value real estate, really bubbly, I just want to sell it and take the cash. And I have people ask me all the time, oh, Harry, I got this one house that's got a big, 90% mortgage against it, but I got another one I've had, for my mother that it's paid off. Oh, I should sell the high mortgage one because that's at risk of foreclosure. And I'm like, no, sell your mother's place, okay, that has high equity, that gives you money to reinvest and have power. Keep the one with a high mortgage because last time they didn't make the banks mark down to market. Next time they're probably going to, at some point, government's going to have to realize instead of pumping up the financial markets with free money or pumping up businesses, you got to help the consumers and businesses. If you relieve debt, or like you say, if you say to a bank, look, what I would have done as the Fed or as the U.S. government, I would have said, I will only give relief in proportion to the amount of loans you write down for real consumers and businesses. If you write down a consumer's mortgage from $400,000 to $200,000, now their house is only worth that, I'm going to give you 30% of that back as stimulus. Otherwise, screw you. Because getting rid of bad loans and bad businesses is what recessions and even depressions are supposed to do. Covering them over and keeping zombie loans and zombie companies and zombie banks and zombie technologies, and unlike this virus, not forcing people to move into new things like more online business, more online working, more online communications. That's what the economy wants. That's what governments should reward people for. Stimulus only goes to people who do the right thing, not the wrong thing, covering up bad loans and bad businesses. So I say keep that house with the 90% mortgage, because you know what? Half of that mortgage might get written off and you get a free gift. And then that offsets your loss in the property. Oh, damn. You sell the one, that's got no mortgage against it, and it goes down, 50%. Well, you save that loss, but man, you're the other one, you actually get a bonus for keeping it.
Well, that's an interesting perspective. Brian, you've been pretty quiet. I think you've just been amazed by everything Harry had to say. Do you have any questions before we wrap up?
Well, yeah, no, I mean, it's fascinating. I think you and I have actually had discussions about apartments and the demographic trends, and he said pretty much exactly what I've said before, so I feel a little vindicated.
Yeah. There's a reason I like to partner with you.
That being said, too, I was curious, Harry, your take on, what possible or potential effects may have by foreign intervention from an investment perspective. Because I would say, as somebody, I grew up on the West Coast in Southern California, and I had a ringside seat for the last downturn, and it fell hard and fast. And then, but I would say it recovered quickly because you had a lot of wealth coming in from Asia and the Middle East that were buying properties for all cash.
Yeah. Well, Brian, guess who's going to lose the most? Okay, two things, two principles everybody should keep in mind. Who's going to lose the most when the biggest financial asset bubble in all of history, making 1929 look like child's play? It's going to be, number one, the richest people in the world who own and bought the highest end of these assets, which is the most overvalued, And number two, who has been the biggest stimulator, the biggest borrower, the biggest overexpander in all of history? China. So there's another rule. If you're real estate, and of course I'm doing a lot of lecturing in Australia right now. It's my favorite country and my best subscribers and readers, because they don't have so many experts to listen to. And I go down there and talk to these people. Is that if you're dependent on foreign buyers like Manhattan and London and San Francisco and Vancouver and Sydney and Melbourne, oh shit, run even faster. These people are going to vanish at the speed of light. Chinese net worth, and they're the biggest foreign buyers in most English-speaking countries, is 75% of their net worth. Even everyday people speculate in real estate more like e-traders do in stocks here. Their wealth is going to evaporate. And when they have to look at, I've got this Chinese real estate, that I own, or my hometown, or my own, and I've got this foreign investment, which are they going to sell first? They're going to sell the foreign real estate first to protect their domestic assets. The Japanese did this in the early 90s. That's why Rockefeller Center went on sale, and Pebble Beach and stuff like that. They helped bubbled up those high-profile, bubbly areas, and they went down the hardest. So anything that's dependent on foreign buying, especially Chinese, get the hell out now. They will disappear and never be heard of again for maybe about a decade.
Okay, so I want to unpack that for 1 second. So are you suggesting the Chinese economy is doomed? Even worse than what we're facing here?
Yes, yes. On this 90-year cycle I talked about earlier, super bubbles, the last one came into 1929. The U.S. was the up and coming emerging country becoming developed like China today. We were the thing. New York City was the Shanghai, the new kick-ass city. Our stocks bubbled the most. Manhattan bubbled the most. All of those crashed. Our stocks crashed 89% blue chip, not small caps. Leading edge companies like General Motors and Ford and RCA and AT&T, the tech leaders, the fangs of the day, 89%. Manhattan went down 61%, while the average home in the United States went down 26%, because there wasn't speculation in homes, because you didn't have 30-year, no doc, no low interest rate mortgages. It was very hard to borrow against real estate back then, so there wasn't this speculation. So
sell Alibaba stock and don't invest in Shanghai?
Yeah.
Yeah.
I mean, Shanghai, I think Shanghai, Beijing, Shenzhen, Hong Kong real estate could go down the most. Now for real estate, this will be almost off the charts, except for Chicago in the big 90-year cycle before the Great Depression one, where it became the New York overnight because of canals linking it to the Atlantic. China will have the biggest real estate bubble burst. It's the most overvalued, and I'm estimating by my bubble model, which has been very good so far in commodities and things that have followed this, 75 to 80% decline. What? Real estate, again, our Great Recession, 2008, 34%. The Great Depression, 26%, because it wasn't so leveraged with borrowing and stuff. Wasn't a bubble like today. 80% real estate with debt against it, and Chinese, listen to this statistic, 75% of their net worth is in real estate. In the US, it's 30%.
Whew.
Australia, where I'm lecturing again the most right now, because they got a real estate bubble. And you know what? They get everything I say, except they don't think real estate will go down. And I'm screaming at them. It's going to go down. They're the second most overvalued in the world after China. And they have 67% of their net worth in real estate.
Wow. That's
oh my God. So you want to say something that injures the consumer and gets them slow to ever spend again? Knock down their net worth in real estate, or put them into foreclosure. Oh my God. So that real estate, when I look at the greatest depressions rather than the greatest recessions in history, with the exception of 1929 and 32 in the US, where real estate was not the biggest factor, although farms were, and farms were basically real estate in a way. Real estate crashing is way worse than stocks crashing, because only the rich own stocks, and stocks, real estate has debt against it, and everybody owns a substantial amount of real estate unless you're very poor. So this is a real estate centric bubble, not just stocks, and it is global real estate, it is global stocks. This will be the biggest crash we see in our lifetimes. And if you have very young children or grandchildren, I would tell them today with my indicators, which are long-term cycles that repeat regardless of politics and short-term crap, okay? The next such crisis will be from around 2065 to 2074. A long time from now. I will be long dead by then. We will have a spring boom after this. That spring boom will be 2023 to 2036, 37. I can calculate that today. It will be in some countries more than other. It'll be almost entirely in the emerging world and in Asia. So, in the future, if you're a real estate investor, you know what I would do if I could do anything in the future after this crash? I'd build parking lots in freaking India. India is going to be the next China, urbanizing rapidly, needing all types of infrastructures. I would buy basic stuff, that can throw off very positive cash flow, like parking
Yeah, low labor, automated, easy
lots.
to manage,
No, I
not a
mean,
lot of maintenance.
the other thing, any infrastructures in India and Southeast Asia, but in my next book, it's called The Greatest Financial Con of All Time. It's going to come out later this year. I'm probably going to only release it digital because my publisher is such a retard that they can't keep up, and it would take them a year to get it out. But Southeast Asia and India are going to be the next China with massive infrastructures and real estate. Most of the developed world, as I kind of said earlier, real estate will never be the same. When you have an aging population and most of the real estate's bought between, to be precise, age 27 when people get married to age 42 when their kids turn into teenagers, which makes you want to buy a big enough house that you want to get as far away from them as possible. That means real estate will never be the same. Aging society tilts the other way to people who need less real estate until they get in their nursing home and assisted living facilities. So I'll just leave you with one thought. As I was speaking to a group last year, and they were in the travel industry, and I said, "Hey, you know what you should do? People promoting cruise ships, which is the hottest part until the virus came along, because that age 74 is the peak of that, rather than global travel at 60, because you do nothing and vacation places appear, customs, no jet lag, no Montezuma's revenge, unless you get on the wrong cruise ship. And is that you be on cruise ships marketing assisted living facilities. Because just when cruise ships peak at age 74, that's when people start moving into assisted living and nursing homes between 74 and 84. That's the last great real estate play. That's the last big sector of growth, along with pharmaceuticals and vitamins and skincare and things like that, for the aging baby boom. And everybody has to remember, on a relative scale, yes, there's more millennials. Every time I hear some stupid ass sociologist or economist say, "Oh, there's more millennials than baby boomers, so the economy is going to get greater." No, as relative as a wave, no, they don't even compare to the baby boomers. And the zillennials don't compare even to the millennials, okay? They're a lesser little bump in the birth waves that drive these dramatic demographic cycles. So catching the aging baby boomers, and the only way you can do that now in real estate, the last thing they do after vacation homes, which is 63 to 65, so that is 2023 to 25. So I would buy vacation homes that crash in this downturn, but sell them by 2025, 26 or so. But assisted living and nursing homes in the real estate sector will grow longer than I live.
Well, it looks like Harry Dent has just planned out our next half a decade or so for us, Brian. So
that's what I did.
We just need to wait for the crash, buy vacation homes, sell them a couple years later, and buy assisted living centers, and then we can retire and be on cruise ships ourselves.
Get out of a couple of commercial office and retail.
Yeah, no doubt. Yeah.
Well, and remember, these McMansions that crash, you can buy them and at first maybe rent them out to dual families because they're big enough. But eventually, these millennials, maybe 10 years from now, they'll want that McMansion as well. So McMansions are a great opportunity to buy, whether it be converting them into assisted living or to double rentals for millennials or zillennials. And then ultimately, everybody's going to want that dream home. And so again, demographics tell you where to buy now, where to sell now, and bubbles tell you the greater the bubble, the greater the burst. That is, and I hate to say this. This is where the rich people are the stupidest people on earth. Rich people think because we're the richest and we're the smartest and we buy this real estate, it'll never go down because there'll always be people like us to buy this shit. Okay? Well, no, there won't. There'll be people like you, but you won't have half the money you have today in this bubble. And so that's what deflates the most. Rich people are the dumb money in real estate today. An everyday person in Omaha, like I said earlier, down the street from Warren Buffett, your house might go down 10, 20%. I wouldn't sell my house if I loved it over that. I'd sell a McMansion if I wanted to downsize anyway. Now my kids have left and cut my risk, but I wouldn't say, oh, if I don't sell this house, I'm in trouble. But you own a Central Park condo in Manhattan, put lipstick on that pig and sell it. That's my advice.
All right, so they got to sell it now.
You know who will listen to me less than anybody in the world? The richest freaking people. They think they're invisible, and they think people like them will control the world like they do today in percentage of assets, and they are dead wrong about that. I have another saying. I'll leave you with this. The quickest way to get stupid is to be rich and successful too long. So think about that.
All right. Hey, thanks for coming on. We really appreciated it. You stayed way longer than you agreed to, so we appreciate that as well. Everyone, we look forward to seeing you next week on the Old Fashioned Real Estate Show. Thank you very much.